Traders, I need you to stop what you're doing now because I'm about to show you one of the biggest macro trades of the decade, and I think almost nobody is thinking about it, or at least nobody's talking about it in science. The kind of trade where the charts scream, this shouldn't be happening, but the policymakers are screaming, we're gonna do it anyway, right? Hell with it. We're talking about a setup so clean, so chaotic, so beautifully stupid that it could send dollar yen to like 200, right? Explode the Nikkei or Nikkei to over 60k and turn JGBs, Japanese government bonds, into a complete and utter attritional battlefield. And at the center of this chaos is a single politician in Japan pushing historic fiscal expansion. And her name is Sanae Takaichi. You might have heard of her. Her plan is simple. Spend. Spend massively, spend in an unconstrained way, spend like it's going out of fashion, spend like Japan wants to break the global macro system and to exacerbate the global yen carry trade. And for traders, well, we're here for traders, right? The opportunity is on a silver platter, waiting to be exploited, waiting to be taken. This is the Sanae Takaichi trade. And if you understand it now, you might catch the biggest FX and equity and bond setup since the Bank of Japan invented, yes, they did, invented QE, quantitative easing. So let's dive in a little bit more. Japan just opened the fiscal floodgates like never before. Sanae Takaichi is pushing an economic agenda that makes Abe's economics free arrow stimulus look like absolute pocket change. I'm talking record-breaking fiscal spending, straight cash injections to the economy, corporate handouts, deregulation, defense budgets just absolutely like tripling, no hyperbole, infrastructure package the size of a small continent's total GDP expenditure, and a government that has basically and essentially said, we don't really care about the debt, we don't care about any deficits, we don't care about like being downgraded. We're going all in. The last hurrah. We're approaching demographic collapse. We've got to get something going, right? We don't want to replace them with foreigners or robots. So we've got to go in. We've got to go all in. We've got to save the economy. So what does that actually mean translated into trader language? Well, Japan is taking the governor off the engine and flooring it, right? Completely. Takaichi has like one motto: spend first, and let's think about it and fix it later. And Japan, they're taking that seriously. That's why I'm talking about the dollar yen possibly going to 200, because the monster is in the detail. And I don't think anybody is ready for this ghoulish eventuality. So let's talk a bit more about the dollar yen. It's the beast, the legend, the carry trade on absolute steroidal growth and enhancers. Every macro chart is pointing to one uncomfortable truth, and that's dollar yen at 200. It is not a meme, it's an actual roadmap. But why? Why, you ask? Why, I hear you ask? Why, Justin? Well, there's a few reasons. Mainly, the US-Japan yield spread is the widest it ever has been in decades. The Bank of Japan is still allergic to any type of rate hikes. Japan is printing like it's a sport going out of fashion, and they've got fiscal bazookas going everywhere in terms of defense spending and on demographic decline worries, and carry traders are harvesting that juicy yield like it's harvest season and they're reaping what they've sowed, right? In a good way. But this isn't FX. This is literal policy divergence turned into a tradable trend. What about the interventions? The interventions are abound and they last 15 minutes, but they cost absolute billions in terms of like keeping the dollar yen above below 160, right? The Bank of Japan is basically lighting their money on fire. They're hoping the chart feels guilty and then reverses. Spoiler, it's not going to. It won't. So what's the trade, right? Let's think about the trade. Buy dollar yen breakouts, obviously. Trade the momentum continuation patterns, which are like, it's the cleanest chart I've seen. It's the cleanest chart I've seen in such a long time. Just look at the 4-hour bull flags. Look at the Bank of Japan panic spikes as they enter the market to try and intervene and push that dollar yen pair down. This is not a currency at this point. This is a runaway train. And there's only one way a kinetic engine the size of Japan ends. And that's an explosion. But what about Japanese government bonds? They were called, not so flatteringly so, the Widowmakers, right? And Japanese government bonds have actually been dead for years. Shorting them was a death sentence. Inflation didn't matter. Supply didn't matter. The Bank of Japan has and had infinite ammo, right? But what about now? The Widowmaker trade is starting to come up. It's like people are dipping their toe in. People are starting to twitch. People are becoming JGB tweakers, right? For want of a better phrase. Japan is issuing record debt. Their fiscal expenditures and their spending are exploding. Inflation is creeping in a place that it would seem anathema and antithetical for it to ever exist. Real yields really mean nothing here, and the Bank of Japan is pretending upward. And any pressure is just a hallucination. Because the tape always tells the truth, even when mere mortals and mere men who have died on the battlefield of JGBs have said it many other times before. And the JGB tape is finally whispering, something's breaking. Something is actually breaking. Something's going wrong. What are the plays then? Well, I would think about like shorting the long end, steeping the trade obviously, shorting Japanese government bond futures if you can, and exploit the dislocations between treasuries and JGBs. But if you can't do that, just express it on dollar yen, literally. Dollar yen to 200. I don't think that's lacking any asymmetry, to be honest, because Japanese government bond volatility is quite rare. It's like spotting a fabled unicorn. But when it appears, you have to mount that unicorn. You have to ride it, right? Or you have to harvest the horn in some way. So what about the Nikkei? The Nikkei to 60,000 might sound like a melt-up scenario, like a pipe dream, but this is where it gets fun and bloody terrifying at the same time. Because if the yen actually collapses, if the government spends like a drunken sailor, which they are, if liquidity floods the system, what do you think is going to happen? Well, the Nikkei doesn't just go up, it goes absolutely vertiginous. It goes vertical. It goes parabolic. Because Japan wants a few things. It wants inflation, it wants higher wages, it wants rising equities, it wants global competitiveness. It's not a lot to ask for, right? They only want what everyone else wants. The Nikkei is already hitting historic levels. And with a weak yen, it's like adding gasoline to the fire. Because exporters, what are they going to get? They're going to get higher profits. They're going to get more competitiveness. They're going to get earnings per share boost. Foreign investors are going to read those flows. Foreign investors are going to see those value plays. Foreign investors are going to look at those metrics, those upgrades, those recommendations, those analyst ratings, and they're going to contribute to the unholiest of melt-ups, right? That's how a melt-up always starts. So how would I trade the Nikkei? I'm buying dips into the 21-day moving average, like easy. Long on clean breakout retest, Nikkei long, yen short pair trades, call spreads targeting 50K. You can get the optionality. I know it sounds insane, but hey, 30K sounded insane. 40K sounded insane. 50K sounded insane until it hits, right? Until it hits those levels and it no longer sounds insane. It just sounds like a piece of history. And that's essentially where it goes to, right? So I'd like to talk about one final thing, and I'm dubbing it the triple macro trade, right? Because this is what makes Takaichi so deadly in its beauty, and her trade so cataclysmic and possibly apocalyptic, right? It's not one trade, it's a three-legged macro symmetry, unholy combination conflagration play. Number one is long the dollar yen, obviously, on the policy divergence, on the fiscal incontinence, on the monetary insanity, and on carry traders absolutely harvesting spread and yield, right? Number two of the leg is shorting JGBs, if you can. Massive issuance is coming, inflation pressures, and the Bank of Japan is actually, they're quite trapped, if you think about it. And number three of the trade is going to be long Nikkei. Because weak yen is going to boost exporters, it's going to boost equity flows, and it's going to lead to them exploding. And the liquidity storm is going to be like nothing we've seen before, right? In terms of the torrentialness and the pressure of the waves coming. All three reinforce each other like a macro composition orchestra. This is the closest thing to the perfect macro loop in Japan or anywhere else that I've seen in years. So it beholds you to get involved, basically, right? But finally, we don't get setups like this that often, traders, right? Japan is about to give us the trend of the year, the breakout of the year, the carry trade of the year, and possibly the FX breakout of the decade. Like dollar yen to 200 isn't crazy. Nikkei 50k wasn't crazy until it hit it, and 60k isn't that far away, right? JGB volatility isn't crazy given the macro backdrops, even though the Bank of Japan is the market, right? Essentially, what is crazy? Well, ignoring it is crazy. Doing nothing. Trade smart, trade patient, trade size only when the confirmation hits, and don't overextend yourself, because there is one thing that's true in these markets, right? When Japan moves, it moves like a freight train without brakes. It's just the way it is. And that, my friend, is the Sanae Takaichi Trade. Don't blink and don't get hit by the Bank of Japan or the Treasury closing the door on your rear end. But yeah, like, share, and subscribe. My name is Justin Burton, and this is the House of Trade. Ciao for now, and good luck.